Hello, ladies and gentlemen. I hope you are fine wherever you are. I am the ACCA tutor, Mr. Jerry Mtumkulu. I'm very happy to take you through this week's lecture on absorption, marginal, job, batch, service, and process costing. All right. So we are going to segment our lecture into a series of videos so that you can consume them with ease. All right. So in this first video, we're going to tackle the issues to do with absorption and marginal costing. Okay. Where time permits, we are going also to tackle the other costing technique, which is job costing. All right. But like I've just indicated, we are going to shorten our videos so that you guys would consume them with more convenience. All right. So without wasting much of your time, let us delve into the business of the day. Now, absorption and marginal costing. In our previous lectures, we have already tackled these two main costing techniques. They are considered main costing techniques because they are actually fundamental to the principles of management accounting. All right. So most of the theories and modern techniques are actually based on these two theories. For example, we have got a costing technique called ABC. This one is another form of absorption costing, which is a bit modified. Then we have got marginal costing, which has also involved or has been modified to become the fundamental of a technique called throughput accounting. They are the principles are actually the same. We also have got what are called what is called the key factor analysis. You learn about this as you proceed with your study. All right. So for the purpose of ACCA MA paper, for our ACCA MA paper, we shouldn't be bothered much about these techniques. We attack them as we go. All right. So you also remember that when we talked of absorption costing in our previous videos, we say that this costing technique is also called total costing. All right. It is also called total costing in the sense that it considers both the fixed cost element as well as the variable cost component when we are valuing the cost of production. All right, so it is considered the total cost technique. Then when we discuss about marginal costing, we say that this costing technique considers only variable cost. Only variable cost matter. All right. The arguments with marginal costing, with marginal costing proponents, is that they consider fixed costs not relevant for managerial decision making. Why do they say so? Because they say that fixed costs, whether we produce or we do not produce anything, are going to be met. So even if we hire a very competent manager, those costs cannot be controlled by him. All right. So by the end of the day, the costs which matter are only those variable costs. Why? Because a manager can come up with, with decisions which might end up reducing those costs or eliminating them outright. So this is why marginal costing is actually considered a best measure of managerial performance. All right. So in this particular video, we are only going to go a step further into analyzing the profit statements of these two techniques. All right. So we're going to talk or to discuss or to demonstrate the preparation of an absorption costing income statement first, and then we'll proceed to the marginal costing income statement. Possibly, we are also going to do what is called a reconciliation. All right, a reconciliation of the two management accounting techniques. All right, so let us go straight to an example, because we've already discussed those, the theoretical aspects related to these costing techniques. All right, so I think if we simply go to this example, we would have done justice to ourselves. All right, let me try to change a pen here. Okay, so we are given the information about X PLC, which produces one product, desks. Each desk is budgeted to require 4 kgs of wood at $3 per kg, for hours of labor at $2 per hour, and variable production overheads of $5 per unit. Fixed production overheads are budgeted at $20,000 per month, and average production is estimated to be 10,000 units per month. The selling price is fixed at $35 per unit. There is also a variable selling cost of $1 per unit and fixed selling cost of $2,000 per month. During the first 2 months, XPLC expects the following levels of activity. So there is January and February. There is production of 11,000 units and 9,500 units in February. Then sales for January, that's 9,000 units, and for February, 11,500. Then you are required to prepare a cost card using absorption costing, and then set out budget profit statement for the month of January and February. Now, for a cost card, remember I indicated that when we are talking of absorption costing, all right, absorption costing, I say that this one is also referred to as total costing. Why? Because it considers the variable cost element, variable cost plus fixed cost. So our cost card is going to include all the variable costs involved in producing a product, as well as the fixed cost involved in the manufacture of a product. All right. So as a template, we expect to see something like this as our cost card. Okay, a cost card should, for an absorption costing environment, should have direct materials, direct labor. Okay, let's just give them a value of X. Okay, then we talk of overheads, production overheads of this much, and some fixed production overheads. Okay, fixed production overheads here, and we get our total cost of producing a product. Okay, this becomes the total cost. All right, so using this template, we can actually attack this first part of the cost card of a desk. All right, so we can come here and say a cost card. Okay, cost card, and we put our dollar per unit, because a cost card is usually for a unit of product. All right, so we start with our direct materials. we are told from the question that each desk is budgeted to require $4, okay, at $3 per kg. It requires 4 kgs of wood at $3 per kg. So the material is 4 kg at $3 per kg. Okay, and we get a $12 total. Okay, and then we go to direct labor. You just have to follow the template I've already indicated. For labor, each desk requires 4 hours of labor at $2 per hour. So 4 multiplied by 2. 4 hours multiplied by 2. Okay, multiplied by 2. And we get our $8. All right, then we talk of variable overhead. Variable overhead. The variable overheads are also given here, and variable production overheads of $5 per unit. So that you just have to take the $5 and slot it in. All right, and then you go to the fixed overhead. The fixed production overheads are $20,000 per month, and average production is estimated at $10,000. So remember, we are working on a per unit basis. So obviously, we are not going to slot the whole 20,000 into our cost card because we are dealing with per unit values. So the per unit fixed cost per unit should actually be 20,000. Okay, $20,000 divided by the budgeted production, okay, of 10,000 units, and we are going to have our fixed cost per unit of $2. So we slot this $2 in here, and then we get our total cost per unit of 12 plus 8 plus 20 plus 5, 25 plus 2, $27. Sorry, $27 per unit. Okay, this is total cost, $27 per unit. And remember, we have to determine the selling price per unit so that we arrive at a standard profit per unit. And we are told that the selling price per unit is fixed at $35 per unit. Selling price per unit is 35. Okay, so this means that our profit, the standard profit, should be the difference, which is $8 per unit. We are done with the cost card. Now let us go to the income statement. Remember, these are income statements for 2 months, January and February. So we are going to say Part B, income statement. The income statements, all right, and we have to be good in coming up with a table. Okay, we have got January and February. As you can see, I'm actually struggling to scale this information because if I'm not careful, I won't be able to come up with the right information and table. All right, so we have got our first month, January, February. Okay, and you can just underline. Okay, so remember, an income statement has has got this particular tablet. For an income statement, we need to use this particular template. Okay, for an income statement or statement of profit or loss, we have sales. Please, you can take down this template. That is sales, that is less cost of goods sold. All right, cost of goods sold. This one is a function of opening stock X, okay, add purchases, all right, less closing stock, and then we get our cost of sales, which should be deducted from the sales, and we arrive at the gross profit. This is actually the standard income statement. And then you then have to let me just try to erase something there. Then you have to less expenses, whatever they are, and you arrive at your ultimate profit. Okay, then you arrive at your ultimate profit. So that's the same logic. Okay, but in the production environment, you discover that the purchases, these what we are calling purchases, could actually be goods produced during that period. All right, the goods which we have produced during the period. All right, or which have been added to production, or the materials which have been added, or sometimes the labor that we have incurred during the period. All right, so that's the thing there. That's the thing. All right, so let us get through this example. Let us continue with the example to see how we can maneuver all the gauges and escapements. All right, so let me just try to erase it. Okay, these explanations are the ones which might end up taking much of the time, but I hope you guys will be benefiting from the prolonged explanation, because by the end of the day, we shouldn't just rush to finish without benefiting the student. All right, so this is why I'm giving you a step-by-step approach. All right, so like I've indicated in the standard income statement, I say that you start your income statement with the sales figure. Okay, so let us plot in our sales. Okay, the sales, we discover that the selling price was $35 according to the question. The selling price is $35 per unit. Right, but how many units we actually produced? We produced 9,000 units. So that's 9,000 multiplied by $35 to get the total sales. So that's let me just say, okay, let me try to make this line. Sorry, let me try to bring this line a bit afar to this so that my workings won't be problematic. Okay, that's for sales. We've got 9,000 units multiplied by $35 per unit, and we get the total sales of how much. If you use our calculators, yes, that's 31500. Okay, and then we proceed to the cost of sales. Remember I said less cost of sales, or less cost of goods sold. Okay, sales are just goods sold, so the value of goods sold. So we say the opening inventory. Okay, we start with opening inventory or stock. The other word for stock is inventory. So that's opening inventory. All right. Were we given an opening inventory for the month of January? According to the question, we are not given any information about the goods which were, about the value of goods which were left in December last year. All right, so that information is not there. So if it is not there, then we do not have opening inventory. So the opening inventory in January is a 0. Okay, there is a 0 value there. So we proceed to the next part. Okay, so it is actually safer to underline this so that we don't confuse this figure with our workings. Okay, for now, then let us talk of materials added. So the material cost for the current production which we incurred. Remember I said the purchases, because in a standard retail income statement we should have put the purchases value. However, in this case we are a manufacturer, so we put the cost of materials which have been procured, the labor which has been used to produce items. So those are the costs we are talking about in a manufacturing environment. So this is a manufacturing income statement. All right, so materials, the material cost, we have determined that the material cost was actually in our income, cost card, the material cost was $12 per unit. All right, but how many units were actually produced? Okay, we produced 11,000 units. So we are going to work with the units produced, not the units sold. Okay, because we are talking of the cost of production. We are not yet talking of the cost of selling items. All right, we are talking of the units which have been actually produced. All right, so although it affects the cost of sales, we are saying the cost of sales are actually based on the cost of production. All right, so this is why we are taking the value of all the items which have been produced in that period. All right, so which means we were expecting actually to have a situation where the sales guys would also sell all those units. However, in the business environment, it doesn't work like that. It doesn't mean that when you produce more, you're going to sell more. All right, it does not work like that. So we are using, for the cost, we are using the units which have been produced. So 11,000 units were produced, and we are saying that each material, each unit was costing $12 in terms of material cost. So that's 11,000 multiplied by 11,000 units multiplied by $12. Okay, multiplied by $12. So we are going to get 11,000 multiplied by 12. That's 132,000. 132,000. All right. Then we proceed to labor. Okay. The labor cost which we incurred. We are still going to use the same quantities of units produced, which is 11,000. All right. Multiplied by the cost, the unit cost of labor. All right. I mean the labor cost per unit of items produced. So we have determined it to be $80, which was the cost of labor per desk. All right. So that multiplied by 8, and 11,000 multiplied by 8, that's simply 88,000. Okay. We then have to proceed according to our template. We say that we have to consider the variable cost, the variable overhead, and we have determined that each unit was having a variable overhead of $5. So we are going to pick the 5 multiplied by the 11,000 units produced. 11,000 units produced multiplied by 5. And we are going to have 55,000. We then have to consider the fixed overhead. The fixed overhead. All right. We determine from our computation this fixed overhead of $2. We then have to multiply it by the total units produced. Okay. All right. That's fine. So we are having 22,000. So we have to add up this cost. All right. Let us try to be quick in adding up. We are having 132,000 plus 88,000 plus 55,000 plus 22,000. That's 297,000. We then have to deduct less closing inventory. Closing inventory. And our closing inventory, ladies and gentlemen, is going to be determined with some form of maturity and expedient. All right. We produced 11,000 units, but we sold 9,000 units. So obviously we are left with how much? 2,000. This is our closing stock. Are we together, ladies and gentlemen? Good. But at what cost are we valuing this closing stock? At what cost are we valuing this closing stock? We are saying our closing stock is 2,000 units, yes, but we have to give it a value. What is the value are we going to charge? This is where the principles of absorption costing should lead us. We have already done the cost card, ladies and gentlemen. So we are going to use the total cost value, which was 27. All right. So we're going to say multiply by 27. and we get 27 multiplied by 2, that's 54. So we are having 54,000 as our closing stock, okay? And we then get our cost of sales of, 297 minus 54,000. That's 243. 243. This is our cost of goods sold. The cost of sales, the ultimate cost of sales. Okay. So when we do that, we then have to determine the gross profit. Gross profit. The gross profit is sales minus cost of sales. Okay, so the gross profit should be 315 minus 243,000, and we should get 72,000. So we should get 72,000 as our gross profit. Okay, as our gross profit. But ladies and gentlemen, I want you to see something here. All right, we had budgeted, according to our budget, we had budgeted to incur $20,000 of fixed production overheads per month, but we ended up absorbing 22,000 fixed overheads. All right, so this actually signals that this gross profit we have determined is just standard gross profit, is not yet the actual gross profit. We need to adjust. Okay, so if we had budgeted 20,000, all right, but we ended up absorbing 22,000, something should actually ring. Okay, so according to our cost per unit, we had determined that the fixed cost per unit was $2. All right, this was the fixed cost, fixed overhead per unit. All right, was $2. So this means that something could have, because the $2 was from 20,000 divided by $20,000 divided by 10,000 units. All right, but when we produced 11,000, it means our fixed overhead became 22,000. All right, so the $2 has been our absorption rate, the overhead absorption rate. Okay, the $2 per unit was actually the overhead absorption rate. So it means that we have absorbed 22,000 as part of the cost of sale. All right, which was a deviation from the 20,000 which was planned. All right, so have we under or over absorbed overhead? Obviously there has been some over absorption because the overhead absorbed have been larger than those planned. So there was some over absorption of overhead. So that means we need to add back. Okay, we need to add back the cost, the extra cost, so that we come to the plan. All right, so we then have to say add overhead over absorbed. Okay, the overhead which have been over absorbed. All right, that's 2,000 multiplied by $2 per unit, and we should get something. All right, we should get something. I mean, it's actually the 11,000 units vis-a-vis the 10,000 units we are talking about. Okay, so the difference here is actually 1,000 units, not 2,000 units. All right, so that's 1,000. So we are going to say here that's 1,000 units multiplied by $2, and we get 2,000. All right, so this one should be added back to the standard gross profit so that we end up having the actual gross profit is now 72,000 plus 2,000, and it becomes 74,000. I'm sure we are still on the same page. That one is 740. Okay, 74,000. Okay, having this information, you then have to proceed to other costs which were identified in the question. The other costs were told of the variable selling costs of $1 per unit and fixed selling cost of 2,000 per month. All right. So if we are told that the selling costs were $1 per unit, it means that we have to multiply that dollar by the units which were actually sold. This is a selling cost per unit. So when we were selling an item, we incurred some cost, okay, and then we have to put that cost into consideration. So we come here and say let us put the line that divides this month. Okay, less selling costs. All right, and we are told of the variable selling cost, and I said that this variable is going to be multiplied by the units produced. Okay, and we were told it was $1, and this should come to 9,000. All right, remember this is a cost. All right, and then we have to worry about other costs there, which were the fixed selling cost of $2,000 per month. So this was per month, so just take the figure as it is, no need for any multiplication. So fixed selling cost, that's $2,000 per month. Remember, these figures now are per month. All right, and we then have to consider if there are any other expenses to worry about. So if there is no other expenses to worry about, we then have to get to our net profit. So we are saying 74,000 minus 9,000 minus 2,000, and we get the actual net profit. Okay, and that's 74 minus 9, that's how much? That's 74 minus 9, 65 minus 2, 63,000. Okay, that's our first part. Then we go to the second month. The second month is now a walkover because we have done much of the work on the first month. Okay, let us do the second month. Second month, we are told that they sold 11,500 units. All right, and the selling price is still $35. All right, so that's 11,500 multiplied by 35. Okay, 11,500 multiplied by 35. 11,000 500 multiplied by 35, we get 402,500. So that's 402,500. Okay, like I said, you just underline that figure so that you won't confuse it with other figures. And then let us talk of let us determine if there is an opening stock. Obviously there is an opening stock because there was a closing stock in January. So the closing stock was this 54,000 as we have determined. So we just have to slot the figure where it belongs, so that we say 54,000 as provided. Okay, 54,000. All right. We then have to remember it. 54,000 was determined after we multiplied 2,000 units by $27. So don't forget about that. All right, and we then have to consider the materials which were used. Okay, materials is based on the units produced. As I've indicated, this was the units produced in February, 9,500, and the material cost, we know that it is 12,000 as seen there per unit. So that's for materials, 9,500 units multiplied by $12 per unit. All right, and if we use our calculator, 9,500 multiplied by 12, that's 114,000. We then have to go to the labor. We simply use the same units which were produced, 9,500, multiplied by labor cost per unit. You just have to copy from January. That's $80. Okay, 9,500 multiplied by 8, we get 76,000. We go to variable overheads. We use the same figure, 9,500 multiplied by the variable cost as in January, that's $5 per unit. Okay, 9,500 multiplied by $5 per unit, that's 47,500. We move on to fixed overhead per unit, but it's based on the units produced, 9,500. Okay, multiplied by $2 per unit, and we get 19,000. Okay, we add up these figures. We should get 310,500. Okay, then when we get that, we then have to ask ourselves, was there some closing stock? Was there any closing stock? Okay, like I said, this was January. Okay, this was January. Our closing stock was 2,000. All right, then in February we produced, let me use another pen color. We produced, in January, in February, okay, we had opening stock of 2,000 because we simply take these figures as our opening stock. Then we produced 9,500. Okay, so if we add them up, we get 11,500, and then we sold 11,500. Is there any stock left? There is a zero. Okay, in terms of closing stock, there is a zero. So we say closing stock here, the closing stock is zero. So we are only left with the cost of goods sold. Cost of goods sold is now 310,500. All right, we then have to deduct this figure. This figure should be deducted from all right, we have to deduct this figure from the sales figure of 402,500. So we get our standard gross profit. standard in the form of budgeted gross profit rather. Okay, so we are left with the gross profit of how much? 402, 500 minus 310, 500 of 92,000. So the standard gross profit is now 92,000. And then we have to worry if we have got an under or over absorption of overheads. We do the same trick. Okay, the same trick tells us where, according to our budget, we were budgeting to incur how much per month. We were budgeting to incur 20,000 per month. However, this time we incurred 19,000. All right, so there was an under absorption. Okay, there was an under absorption of overhead. Right, so which means we have to deduct more from our profit. All right, we have to deduct more from our profit. Okay, so what we do is we then have to come here and say less under absorption. Under absorption. Okay, less under absorption of overhead. Under absorption of overhead. All right, and how much is this under absorption? All right, let me try to get this pen. All right, we had budgeted to incur 20,000, but we incurred 19,000. So obviously, in terms of dollars, that's 1,000. But you can do the same using the units involved. Okay, we planned to produce 10,000, but we ended up producing 9,500 units. Okay, as you can see here, we produced 9,500 units. So obviously we under produced by 500. Okay, so multiply by the overhead absorption rate, which we determined as $2. So we are still going to come at $1,000, the overhead absorption rate. So we simply come here and we say under absorption was 1,000. We under absorbed, so the cost should we're actually higher, but we under absorbed. So this means our standard gross profit is going to be reduced. Okay, it's going to be reduced. All right, it's going to be reduced. So to become 91,000, which is the actual gross profit, the actual GP. All right, then we have to factor in those expenses as we did before. So that selling costs, and this time these ones are based on the units which were sold. We sold 11,500. So that's the variable selling cost were 11,500 units multiplied by $1, because according to the question, as you can see, they were $1, all right, per unit. All right, so that's 11,500. We then have to factor in the fixed cost per month, which we said it will be 2,000 from the question. Okay, 2,000. So that's what we do. Remember, these are in brackets. They are costs. All right. So if you deduct these costs from your actual gross profit of 91, let me just say 91,000 minus 11,500 minus 2,000. We get 77,500. All right. That's how we do it, ladies and gentlemen. Let us quickly go to the other example which follows. All right. We have got Edgar's PLC, which budgets on working 8,000 hours per month and having fixed overheads of 320. So according to this company, all right, they have budgeted to have total fixed overheads of 320 according to their budget, and in terms of activity, they have budgeted 80,000 hours. All right. So from this information, we can determine the fixed overhead absorption rate. The fixed overhead absorption rate, just as we did in the previous example, that's 320,000 divided by 80,000, and we get $4 per hour. Okay, that's $4 per hour as fixed overhead absorption rate. Fixed overhead absorption rate. Okay, or overhead absorption rate. All right. But, I mean, you can do that before you even go further to the question. They are just important workings which might actually lead you somewhere. All right, let's proceed with the question. During April, the actual hours worked are 78,000 and the actual fixed overheads are 315,500. Calculate the overhead absorption rate per hour. We've just done that. Let us go to part B. All right. Amount absorbed. You have to determine the amount absorbed. All right. And here we are told that the actual hours which were worked were 78,000. Okay, but we know that the overheads are being absorbed at $4 per hour. So we just have to multiply the $4 per hour there, and we should get 78,000 multiplied by $4 per hour. That's 312,000 as the amount which have been absorbed so far. All right. What about the actual overheads? Actual overheads, all right? The actual overheads, we are told from the question, they are 315,000. Okay? That's the actual overhead which have been incurred by the firm, all right? So, were the overheads over-absorbed or under-absorbed in this case? All right, ladies and gentlemen, I want you to see this. All right, the amount absorbed, all right, the amount absorbed was this one. All right, but the actual overheads which were incurred by the company was 350. So in this case, there was an under-absorption. All right, there was an under-absorption because we actually incurred this one. But according to our overhead absorption rate, all right, we had absorbed the 312, which is, the budget was showing that we would incur 312,000, but actually what we incurred was 350. So there was an under absorption. Of 315 thousand minus 312,000. Okay, these are in dollars, and we should be having 315,000. There is a 500 here. Remember, 315,500. All right, so that's, we are going to have a 3,500 difference as the under-absorbed. According to our plan, we under-absorbed. Okay, and I'm sure this one is again consistent with what we discussed in this example. All right, this example showed us that we had a similar situation. Okay, we had a similar situation. Okay, ladies and gentlemen, I think we just have to move on, and we need only to replay the videos where we are lost. Okay, let us just try to race with the time. Now we are moving on to marginal costing income statement. Like I've said, marginal costing considers variable cost as important. Actually, it considers the contribution being a very important tool for decision making. And when we are saying contribution, we are just referring to the contribution towards fixed costs. All right, so we have to thrive by all means that the contribution we make out of selling something should be able to cover our fixed costs, and then if we are left with something, that would be our profit. All right, so we are saying selling price minus variable cost is equal to contribution, and we are saying this figure is the most important figure in our mathematics so far. So let's have a question. Okay, let's try to have a question which would enable us to understand the concept better. All right, as I have indicated, in marginal costing, only variable costs are charged as cost of sales. So in the equation which I've indicated, that selling price, let me try to use this pen. Okay, I said selling price minus variable cost is equal to contribution. We are saying for the cost of sales, we are only going to consider this, okay, as the important, as the cost of our sales. We are not going to consider the fixed cost element. We are only concerned with the variable cost. So the total variable cost should constitute our cost of sales. Okay. So continuing from the facts we have already covered, we should come up with a variable cost card. All right. So our cost card, as we did, should actually be based on the remember we are charging per unit. Okay, so we start with the direct materials. The materials, from the question, we are told that 4 kg at $3 per kg, that's $12. Okay, and then remember, these materials are usually called direct materials. They are variable. Okay, they are variable things. They are variable costs. All right. Then labor is also considered variable. Okay, direct labor. Labor is being paid at $4. 4 hours at $2 per hour. So that's 8. And then and variable production overheads are $5 per unit. So variable production overheads are $5 per unit. All right. Do you have any other variable cost? Obviously not. We're not going to consider this because it's not a production cost. Here, for the valuation of inventory, we are only concerned with production costs. So selling costs are actually out. So we say 12 plus 8 plus 5 plus 25. That's the total variable cost, which we call marginal cost. The marginal cost per unit, all right? That's that one. Okay, or the total variable cost, that's that one. Okay, now when we do this, we then have to come up with the income statement, all right? The income statement, but we can also proceed further to come to the standard profit per product, as we did in our absorption costing computation. I mean, absorption costing cost card. We also proceeded further to the issue of standard profit per unit. So we can say selling price. The selling price is $235 per unit less marginal cost. Okay, the marginal cost of the product, which we determined to be 25. All right. We then have to consider the selling cost, variable selling cost less variable selling cost per unit, which was $1 from the question. It was $1. So these ones. So our profit should actually come to $9 per unit. That's the standard profit. Per unit. All right. Then with this information, we can safely now prepare our income statement, marginal costing income statement. Income statement. The marginal costing income statement, ladies and gentlemen, will, as usual, start with the January, the February. Okay, let us rest with time. We start with sales. The sales figures are actually going to be the same. We can just incorporate the sales figures which we did compute in our previous. We determined 315 in January and 402. All right, let us start with the January figures. That's 315,000. We just have to incorporate those ones. So that's 315. Okay, I'll just use dollars. So that's 315,000. Okay, so that's 315,000, and then we have to consider the cost less cost of sales, which are going to be, as you have already seen, the cost of sales are going to be, according to the computation, we're going to have the opening inventory. All right, the opening inventory in January there was 0, if you still remember. Okay, in January there was 0 because there is no information for the opening stock. So we are going to say 0 here. All right, and this figure could be underlined so that we are not going to confuse ourselves. All right, so in terms of opening inventory in January, we have got a 0 opening inventory. All right, and then we have to add the materials which were procured. Okay, for materials. All right, we know that in the first month these were produced. Okay, 11,000 were produced of materials, 11,000 units multiplied by the material cost per unit. Material cost per unit, we determined it here to be 12. So we slot in the 12, multiply by 12, and we should get our 132,000. We then go to labor. The labor is also based on the 11,000 units multiply by the labor cost per unit, which is $8. So we are going to say multiply by 8, and we should get our $8,000. All right, do you still have a space to write something? We can go over leaf and talk of the variable overhead. All right, the variable overhead, okay, the variable overhead is also going to be based on the 11,000 units which are produced, multiplied by $5 per unit, because we determined that it was $5 per unit. So that's $5 per unit, and we are talking of 55,000. All right, then we have to add up these costs. Okay, we add up 132 plus 88 plus 55, and we are talking of 275,000. Okay, then we have to deduct closing less closing inventory, and we did compute this figure because we said if they produced 11,000 but sold 9,000, obviously the closing inventory that has been left is 2,000. So closing stock is 2,000. Okay, so that's 2,000. We're saying 2,000 multiplied by a certain figure. How much in terms of cost of sales? Obviously, the cost of inventory should be based on the cost of production per unit, the total cost of production, and they are in marginal costing, ladies and gentlemen. So we go back to our marginal costing cost card. So the marginal cost for a product is $25. So that's the total cost we are going to use. So we are going to say multiply by $25. Okay, so we then have to get our 50,000 in place here, and this figure is deducted from the above figure, and we get the 225,000. Okay, we then have to deduct some other variable costs. Okay, we have to consider, we just have to follow our sequence. We come to this part. Okay, sorry, not that part. Just have to follow some sequence. All right, where we talked of the variable selling cost. Okay, there was a point where we talked of, this one should also be considered now, the selling cost. All right, we have to consider them. However, before we do that, we then have to consider the contribution. All right, because we are saying sales minus variable cost is equal to contribution. These are total variable cost. Total variable cost. All right, we have to deduct these ones from the sales. If we deduct from the total sales was 315. Okay, so 315 minus total variable cost of 225, we get contribution of 90,000. Okay, so we say less variable selling costs. Okay, selling cost, and this one we determine that we sold how many units? We sold only 9,000 units in January. So that's 9,000 multiplied by variable cost per unit, which was $1. Remember, it was $1 from the question. That's $1. All right, so that's less 9,000 here. Okay, That's we get that. All right. Normally, okay, as we did in our gross profit uh, computations or gross profit computations, uh, we determined that there was some need of adjustment of standard gross profit and the actual gross profit. Here we can also do the same, all right, and we adjust our contribution to come to the actual contribution, okay, actual contribution, because the variable selling cost would also need to be deducted, and we then arrive at our actual contribution of 81,000. All right, then we have to deduct the fixed cost element. Okay, fixed cost. We have got production fixed cost as well as selling cost fixed costs. So for the production, we simply use the information from our budget. Okay, we were budgeting to have 20,000 fixed costs there, so simply slot in the figure, and then the selling costs are also said to be 2,000 per month, which were fixed. All right, so we then have to slot in those figures, and we come up to 81 minus 20,000 minus 2, we get 59,000 as our actual net profit. But then I have to go to February. Okay, for the February, let me try to use a bit different pen. Okay, let me try to use this one. All right, the February sales, according to our computation, we sold how much in terms of February? We sold 11,500 at $35. So that's 11,500. It should be the same as the figures which we determined in our absorption costing example. So we determined 402,500. All right, let us underline this figure. Then we have to deduct the cost of sales, the opening inventory. Obviously, the opening inventory is now there in February because we have a closing inventory of 50,000. So that's our figure there. We have to slot in that figure. That's our opening inventory, opening stock or opening inventory, 50,000. All right, then material costs, materials. All right, material cost, we produced how much? We produced 9,500, okay, multiply by, so we just have to slot 9,500 multiply by the cost of materials, which we determined from our, let me try to erase this, okay, so that I put new ticks, okay, that's $12. So that's 9,500 multiplied by 12, and we should get our 114,000. We do the computation for labor. The labor is also based on the 9,500 units produced, but I still remember it's $8 per unit. Please verify. If you multiply by 9,500, you should get your 76,000. Let us go over leaf, and we go to the variable overheads. Let us just follow our former format, and we are saying we produced 9,500 in February multiplied by the variable cost per unit of $5, and we should get our 47,500. You go to adding up these units, these figures. If you add them up, you should get 50 plus 114 plus 76 plus 47.5. You should get 287.5. 287 500. All right, then you have to deduct closing stock. And as we did before, we verified and we determined that there was a zero closing stock as everything was sold up. All right, so we are going to get to 287,500 still. All right, when we do that, we should then deduct this figure from the selling price, and we should get some standard contribution. Standard contribution. Okay, standard contribution. The standard contribution should actually these ones are the same as total variable costs. All right, then so standard contribution is determined from total sales minus variable costs, and our total sales for February was 402,500 minus 287,500, and it was 115,000. But then you have to say 115,000. Okay, what about the variable selling cost? Selling cost. Okay, and these are based on the units sold multiplied by $1. Okay, units sold multiplied by $1, that's 11,500. Okay, and we should get to our actual contribution. The actual contribution, that's 115,000 minus 11,500, and we should get 103,500. All right, and then we have to consider the fixed costs. The fixed costs, we've got production fixed costs and selling fixed costs. All right, so for the production, we are told, okay, go to the question and consult the question here. This is the paragraph. Okay, that's 20,000 according to the budget. Okay, and then the selling costs are still 2,000. So, and we should arrive at 103,500 minus 20,000 minus 2,000. We should get our 81,500 as our actual net profit. All right, let's try to do some reconciliation to see where where were the differences emanating from between the two methods. All right, so reconciliation, right? Reconciliation. Okay, we've got our 2 months, January, February. Okay, dollar signs. All right, let's start with absorption. Costing. The absorption costing profits were how much? Let us try. I'm sorry, let me just take you back, ladies and gentlemen. This is for benefit. All right, so the actual net profit in January 63 and in February 77,500. So let us plot in those figures. All right, just keep them in your mind. Said 63,000 and 77,500. And then for the marginal costing, we determined a profit of how much? That's 59,000 and 81,500. All right, so what was the difference? Here we are having a difference of 4,000. Here we are having a difference of 4,000. All right. Okay. Now, the fixed overheads, the fixed overheads in inventory should actually explain these differences in inventory values. All right. There were some fixed overhead elements which were actually, within the values of inventories when we were using the absorption costing. But when we were using the marginal costing, there were no such fixed overheads, right? So we had opening inventory, the opening inventory in February. Okay, of course, in January there was a zero. All right, there was a zero because we had no items of inventory which were brought forward from December, right? So in January we had zero, but in February we had opening inventory of 2,000 units, if you still remember, because we determined that there was closing stock of 2,000 in January. So this became our opening inventory in the month of February. So we consider that here and we say 2,000. All right. But the fixed overhead value in each unit of inventory was the fixed overhead absorption rate of $2, which we determined earlier on. So that's multiplied by 2. Obviously, this gives us a 4,000. Okay, which should be deducted in our in February. Okay, so it actually accounted for that difference there. Okay, it accounted for that difference. All right, now the closing inventory in January. In January we had closing inventory. Okay, the closing inventory was the same 2,000 units. Okay, same 2,000 units, and this gave us the 4,000. All right. Okay, so you can see that it is actually the issue of these fixed overheads which which explain these differences. All right, it is from these fixed overheads within the inventory values which actually explain why we have the differences. So, but by the end of the day, when all the stocks have been finished, the ultimate, all the differences are going to be curtailed. All right, we will still have the same profit in the long run. Okay, when we sell everything. So what happens is absorption profit gives us a larger profit figure if we close this with inventory. If we have what closing inventory, then we are going to have absorption costing profit having a larger amount than that of marginal costing. This is why in January, as you can see here, in January we end up having 63 against the 59 for marginal costing. Why? Because we had closing inventory of worth 4,000. The closing inventory overhead element was worth $4,000 in that month. Okay, the fixed overhead value. Then in February now, we only had opening inventory. All right, but we didn't have the closing inventory. So in that situation, we have the marginal costing income statement having a larger profit than that of the absorption costing. All right, I'm sure that we are done. Let us move on, ladies and gentlemen, to other aspects where we need to elaborate. So the issue is when we are talking of these two costing techniques, we should bear in mind the impact of their valuations on inventories. All right. So if inventories increase in a period, absorption costing reports higher profit. Okay, so it's actually an issue of inventory levels. All right, if inventory increases, then absorption costing reports higher profit. Okay, why? Because fixed overheads are included in closing inventory. All right, so the fixed overheads are included in closing inventory, which in other ways it reduces the cost of sales. When we have got more overhead in closing inventory, then the ultimate cost of sale, the ultimate cost of sales figure is actually going to cost of goods sold figure decrease. Okay, when the cost of sales figure is decreased, then profits become higher. The distance or the gap between the cost of sales and the selling and the sales gets wider. Okay, gets wider. But the converse is true. Okay, when there is a decrease in in inventory levels, then absorption costing reports lower profit. All right, because the fixed overhead is actually included in the opening inventory. All right, if the overheads are included in the opening inventory but not in the closing inventory, it means that the cost of sales figure is going to be larger. All right, thereby restraining the profit or making the profit lower. All right. Now, why do you think are the arguments for absorption costing? Arguments for absorption costing or in favor of absorption costing. All right, fixed production costs are incurred in order to make output, and so it is only fair to charge all output with a share of these costs. Closing inventory will be valued in accordance with International Accounting Standard number 2 inventories. Okay, so by doing absorption costing, we are actually not likely to be penalized by our listing or the securities exchange rules. Okay, I mean in violating them, or in terms of violating international accounting standards or the IFRS, we are not going to be found on the wrong side of the reporting frameworks. All right. Appraising products in terms of contribution gives no indication of whether fixed costs are being covered. So if we only rely on variable costs for decision making, we are highly likely to be found on the wrong side of decision making because we won't be considering the fixed cost element. What about the arguments in favor of marginal costing? We are saying here absorption costing information is irrelevant when making short-run decisions. Okay, so in the short run, the fixed costs, they're actually irrelevant. All right, so when we want to make quick short-run decisions, it's actually better to rely on the cost which we can control. That is the variable cost. It is simple to operate. There are no arbitrary fixed cost apportionment. Remember, when we were using the overhead absorption computation, there was the issue of whether we're going to absorb them on machine hours or on labor hours, and how do we know what percentage should actually be incorporated in a product, or in this department there is a whole lot of unnecessary difficulties when we are using the absorption costing technique, especially when we want to apportion those costs properly. Fixed costs in a period will be the same regardless of the level of output, and so it makes sense to charge them in full as a cost of the period, not the cost of the product. It is realistic to value closing inventory items at the directly attributable cost to produce an extra unit, which is the issue of marginal costing. Then under or over absorption is actually avoided. Absorption costing gives managers the wrong signals. Goods are produced not to meet demand but to absorb allocated overhead. Absorption costing profit may therefore be increased merely by producing in excess of sales. You discovered that when we were having closing stocks, because there were elements of fixed overheads which were in the cost of the product, the profits were actually larger because of that unsold inventory, which is actually wrong in theory, all right, because those items have not been sold. What if customers are not going to buy them, yet we reported they affected our profit, and customers are not going to buy them? Then we will be giving managers wrong decisions. Now, let us get into another gear, ladies and gentlemen, for the job batch and service. Job batch, service, and process costing in our next video. All right, this is a task for the next video. I hope you have been treated well and nice so far. Enjoy your watch. Thank you.